Well, American banks are about to learn the results of their latest stress tests from the Fed, with a passing grade expecting to be a catalyst for billions of dollars in stock buybacks and dividends. A move that my guest today on StansberryInvestor.com says will prop markets and inflate share prices again. Please welcome back to the show, Nomi Prins. Nomi, always good to be with you.
Yeah, it's always fantastic to be with you. We cover so much awesome stuff.
I was so excited to see you on the schedule. I was like, yes, because I have so much ground to cover with you. So getting back to the stress test and the banks, they're going to get their passing grade from the Fed. Probably will be glowing marks here. A move that you say is bound to prop up the markets, inflate them once again.
Yeah, I mean, it's important to note that the Wall Street, the major banks in particular, the conglomerate banks that do asset management and savings and loans and checking and trading and security creation, the big banks, they kind of had been soft relative to a lot of the sort of rebalancing trades in the wake of the pandemic. I mean, they've risen recently, but they haven't quite gotten back to sort of keeping their recent highs. And one of the reasons for that is they weren't allowed for a while in the wake of the pandemic last year by the Federal Reserve to buy back their own shares. Buying back shares, not just for Wall Street, but for major corporations in general, has been basically a ticket to utilize cheap money from the Fed to inflate their shares, i.e. buy their shares with, inflate their bonuses, inflate their compensations, and so forth. And that has a knock-on effect to the rest of the stock market as well. They've been a bit sidelined. And what these stress tests basically do, and let's not forget, stress tests are effectively created by the banks for the banks. They're created in concert with the Federal Reserve. It's not like there's like these extra agents that go in and try to figure out where the major risks would be in a bank and really do forensic kind of analysis on that or anything of that nature. These are tests that are basically rubber stamped, suggested, modified by the banks with the Federal Reserve. So not passing them is akin to having like all the answers to like a final exam and then messing it up somehow. It's almost impossible to do that. And what the rubber stamp of the stress test basically indicates is the Fed, which has already said earlier this year that it will lift those buyback restrictions for the banks. It kind of gives them another sort of quiver in their arrow thing to basically say, all right, and by the way, they've passed these stress tests. You know, they've gone through this really difficult time. Again, they're fine. The fact that we said they could buy back their stocks, we're just rubber stamping one more time. And that's what's going to happen. Now, they have a lot of cash on their balance sheets because money was made so cheap, because there was a lot of savings that came in terms of people just not paying for things, not spending as much money during the pandemic, that all basically accreted to the banks, and record trading volumes and fees as retail investors came into play. So the banks are going to use all of this, use the stress test positivity, and get back to buying their own shares, which is going to elevate them and therefore kind of take a lot of that aspect of the market up with them.
So with the banks basically in bed with the Fed, not to use that expression, but that's basically what's happening here, Nomi. How does that trickle down and affect us at the end of the day?
Well, from the standpoint of anyone who is invested in elements of the market, I mean, whether that is mega caps, banks, energy, small caps, whatever it might be, the effect of what has been ongoing incredibly cheap money policy from the Fed, their QE policy, which has now provided them a book of more than $8 trillion worth of assets, which is larger than most countries in the world in terms of the equivalent size to economics. Also will allow the markets to effectively ride up again. It will give sort of another reason to continue to move up on the Fed. So regardless of the fact that the Fed came out recently and said, we might raise rates according to our dot plot, which is generally a 50-50 anyway on what actually happens at most, but that we will raise rates in 2023 potentially rather than 2024. That spooked the markets. Inflation has been rising. That spooked the markets. But then Jerome Powell came out and said, well, it's transitory. We didn't really mean it, et cetera, et cetera. cetera, this will be like just another reason for the markets to kind of take a breath and say, you know what, cheap money's here. These central banks are providing it. They will find any reason to continue to provide it for the foreseeable future. And I think that's just going to give an actual bid to what is an artificial inflation component of cheap money to the markets, and investors in those markets could benefit by being in the right sectors, just from that general sort of upward thrust of that sort of consolidation on cheap money.
And Nomi, I believe this really speaks to a point you've been hammering home for a long time now, because you've covered central banks since the 90s, and you've said in the past how you've seen them evolve from being background players to becoming the market, and how they've actually changed the nature of finance.
Yeah, that's right. Without if we could just even imagine this scenario, let's say tomorrow, all the central banks basically say, all right, economies are kind of doing okay. We're going to retract all of our cheap money. We're going to raise rates to some sort of an average, which is like 5-6% over the decades before the financial crisis, let's say, over the quarter century before that. We're going to, unwind our books, and we're going to dump trillions of dollars of assets onto the market. I mean, you can just imagine that, like Armageddon, like times 1,000 that would happen from that. And if you look at the complement of that Armageddon, which would happen if the Fed and other central banks remove their subsidies to the markets, you see why the markets are where they are. In the background timing of banks before the financial crisis, of central banks before the financial crisis, yes, they didn't have the thought, the wherewithal, the imagination to even remotely provide the kinds of subsidies that they have done in the wake of the financial crisis, and that they have doubled down upon in this phase two component of that in the wake of the pandemic crisis. It's inconceivable that they would take that power and the power of those subsidies off of the table, because we see that even when they wobble a little bit, say, there is some inflation, we might raise rates, things might change, markets generally freak out. They're not unaware of this. And so though their narrative, and particularly recently in the last decade and a couple of years, has been, we're helping the economy, we're helping the economy. The markets are a byproduct of the economy. No. The markets are what is driven by money. It's very, very simple. It takes a long time for money to manifest in any element of the economy, because it requires work, investment, growing customers, whatever it might be. The markets, like you put it in, things go up. It's a manifestation of its own self. And that's what we have. And that's why central banks have had so much power into the pandemic, while they were turned to as the pandemic was coming, and while they have received basically all of this extra sort of elevation in just what they do, particularly in the developed countries relative to the markets, the financial system, the banking system globally. It's a little bit different with developing markets, who in this particular phase, the pandemic phase of central bank power, have kind of gone along with it because they've had to reduce their rates by higher heights. So they've actually had more of a movement in rates, but they can't keep that going without the Fed keeping it going. So in order for money to be cheap around the world, the major central banks, primarily the Fed as the leader, have to and do and will keep it going. And they will find reasons along the way to do that. Every single time something is reached. Inflation gets too high, it's unemployment. Unemployment sort of changes, it's inflation. They'll find a reason to keep it going.
Okay, so would you say that they've lost control and have to pivot every time, whatever hole opens, or are they in complete and absolute control?
That's a really interesting question. They're not in absolute control, because we do have emotions in the market. We do have crises that come from an external perspective, like the pandemic, or like a financial crisis. It could be a debt crisis. There could be a climate crisis. There are things that can come externally that the Fed or central banks obviously cannot control. But what they can control, because there is no actual legislative barrier in their way in any country, is the ability to dive in when they need to with these subsidies, with these cheap money policies. There's only so much you can go down below zero. And in Europe and in Japan, for example, rates are on average negative. But besides that, they can't control the crisis, but they have absolute freedom on their quote remedy to the crisis, which tends to, as we've noticed in the last two crises this century, increase as each next crisis comes. So if we have another crisis, we could see the Fed's book from 8 trillion to, I don't know, 12 trillion. There's no, we are seeing a pattern of growing their power, regardless of what extraneous circumstances pop in.
So Nomi, let me ask you, you mentioned the T word before, transitory, probably the word of the summer here. And there's so much debate about, will we have a transitory inflation, runaway inflation, or hey, it's not inflationary at all. We're actually in a deflationary environment. Where do you sit on this debate?
So I look at the data. And first and foremost, there's been an inflation of asset prices because of these policies we've just been talking about. There's no doubt that the stock market, the NASDAQ, the Dow, other markets around the world would even be remotely near these heights were it not for the inflating capacity, let's not say inflation, but the inflating capacity of this artificial form of money, of cheap money, of QE and so forth. So that's number one. Assets have been inflated. Central banks tend to ignore this or just kind of not notice it, and it doesn't really count. But it's an element of inflation that's always been there and will always continue because of this external subsidy. That's not different. That's not transitory. That's just how it is. Now, inflation in terms of commodity prices, in terms of precious metals prices, in terms of food prices, in terms of anything that might be material resource types of prices, those are things that have inflated relative to when they were basically not moving and supply was shut down in the beginning of the pandemic period. Before the pandemic began, a lot of the supply was basically subdued for other reasons that had to do with trade wars and tariffs. So even before we got to the pandemic, we had a slightly subdued level of a lot of these types of commodity and precious metals and other types of prices. Some of them have gone up all along the way since things have reopened and since investors have diversified into some of these areas to basically capture all of the mini waves along the way of assets inflating. And that has had the effect of also accumulating a higher level in commodity prices. That's real. So the fact that there is more demand than supply, that's real. That inflates prices. The fact that supply was low because of closures or because of pre-closure, pre-pandemic economic slowdowns and trade wars, that's real. So we are inflated from that. I don't see that as necessarily transitory. Transitory means that the levels that we are at, not the appreciation, but the actual levels that we are at are going to go down. I don't think that's the case because I think that economies have a long way to still reopen and still regain with some behavior changes and modifications along the way, but regain sort of the growth pattern that they might need to basically sustain growing populations coming out of the pandemic and everything else. And I think that will give a lift to those prices. I don't think it's transitory, but I also think an element of it had to do with how low we were to begin with. And I think what tends to happen when we think about inflation is it all gets lumped into like one number and we don't look at the grays like that in between. So that's how I basically see it. I see those prices rising. So I don't see inflation as transitory, but I also see an element of it as having come from these lows, having come from the economic slowdown into the pandemic.
Nomi, let me ask you, because since we spoke, central banks, the ECB, the Federal Reserve, have become more and more vocal about their interest and move towards a digital currency, saying they're looking at it, they're going to put out papers, they want to get the public's opinion on it. The Fed before in the past said, look, we don't care the beta first, but we want to do it right. Now it seems that they're moving along in this race at a faster pace. Are you surprised that they've come out saying they're interested in moving towards a digital currency or looking at it? Or do you think that they've already worked on it and are much more further along than we think?
That again, excellent question. I think it's the latter because here's the thing, even before the pandemic, before we had a lot more retail investors getting involved in Bitcoin and having sort of the sort of crypto asset class coming out and being more accepted in terms of new ETFs, new asset management programs, more Coinbase, and sort of all of these elements of access to more and more people, even before that was happening. and there's reasons for that, of course, is that these central banks years ago were hiring people. Like the one sort of mode of where you could get a job if you were, sort of coming out of school as a good programmer, you didn't want to work on Wall Street and you didn't necessarily join any sort of a crypto company, and you were interested in it, was to basically get a job at the ECB, at the Fed, at the BIS. These are things that have been public and open. So they're definitely have been working not just on gaining, knowledge, but actively setting up systems and hiring actual people to modify and create and develop them. So this idea that now they're sort of looking at Bitcoin and sort of the external to central bank crypto world, and sort of taking it on at this moment, I think is a way of also sort of creating space for them to basically push forth what they have developed in terms of digital currencies of their own. Because if you can't be in the narrative, if you can't control the narrative, you change the narrative. And so what central banks have done is say, look, we know this is happening. We know that digital and crypto are going to be a thing. Otherwise, we would not be so afraid of it, and we would not have to develop our own elements of it. It's a thing. And so that's what's really been going on. And so what's happening now, the sort of chatter about it, is really just an add-on to what has already been in development.
Nomi, how important is it or crucial to be somewhat out of the banking system today and to be looking at other assets besides having cash in the bank?
Well, I think that idea in general of not just having cash in the bank, or if you have cash, keeping it sort of elsewhere, is because we are in a diversifying world, and not diversification like it used to mean in terms of asset allocation, portfolio optimization type thingies that were sort of prevalent in the beginning of sort of the rise of all the asset management elements of society and companies. This is a period where people actually can gain information and education and have a lot of access to managing their own money. And part of managing your own money is taking it out of the system and taking it out of necessarily hands of banks, where it's used for their own speculation, their own trading activities, their own securities creation, their own fee generation, and basically take it in to be a more independent type of a process for people in general. There's just a lot more information. Now that doesn't mean all the information is good, and that doesn't mean there isn't a lot of sort of waiting to go through WADING of what's out there, to be secure in the knowledge, and not just do any old thing that comes, sort of into your inbox. But it does mean that it's important, and I've always found it important anyway, to diversify from one bank. I don't think anyone, even if they have money in banks, should have all of their money in one bank, because things can happen. Things can happen in terms of even a hack to your bank, where you need access to your money, and it's like, okay, well, you can't right now, or whatever, or to your card, or whatever it might be. So I think it's important to diversify your cash. Once you've diversified your cash, then you have more avenues to diversify your investing with that cash, and whether part of that investing is longer term. Whether that is in sort of the market, but not as a sort of trading back and forth in and out element, but just sort of longer term horizons, whether that's in precious metals, whether that's in commodities, whether that's in crypto, whether that's in savings elements that produce more return, you have more options. And so yes, I always think that you use a bank basically to pay your bills. If you're using it, and you keep as little money in a bank as possible anyway, but certainly diversify it and find other ways to even do that.
I guess, Nomi, my final question to you, because besides being, an international best-selling author, you're a renowned speaker. You travel the world giving talks, especially to women, helping them navigate the financial world. So during this current environment, I guess just closing notes for investors and our viewers watching, how is one to navigate the current waters we're swimming in here?
That's an excellent question. And, you mentioned women who, just as a proportion of sort of active investors, are rising now, but haven't been to the same extent as men in the past. And so you balance that out more. I mean, it's good for the markets, it's good for women. And I think right now, The main thing in general, like the one rule to navigating investment in markets, and whether that investment is, short-term, more speculative investment, never obviously bet more than you can afford to lose. I mean, that's key. I'm not the only one who said that. I can't take credit for it. That's obvious. But to maintain a clear head, and to maintain your a situation where you can take your emotions sort of out of your investment activity. There's three types of money basically for individuals. There's the cash you have on hand, there's the money you might use to speculate, and there's the money you might use for longer term investing. And you have choices along all of those three elements of what you do with your money and how you do it. But the main thing is, if you do that, and if you consider those three elements, one's like basically instantaneous, one is a little less than instantaneous, and one is longer term in terms of time, you keep out of the chatter. You keep out of, oh, Bitcoin just did this today, oh, banks just did that today, oil's at its highs, oil just is, just had a 15 second drop, and now it's lower. All of these things that you basically take out of the equation, and you stay ahead with these three buckets in a way that you can basically manage your own diversification that works for you. I think that's key. I think what we've been seeing is a new pattern in the markets where there's so much emotion. There's so much choice in a way between asset classes. It's like, if you're not in meme stock today, then you're in crypto. If you're not in crypto, then you're in like gold. If you're and the idea is to be able to sort of spread yourself in such a way that you're still moving forward with your investments, that you're not allowing the sort of whipsawing of chatter and headlines and sort of just all sorts of noise impact your financial emotions and your actual financial wealth growing capabilities. And I think that's really the key thing, is to stay steady. It's like any sailing situation. You don't get the boat to shore when you're in choppy waters by whipsawing yourself back and forth. You batten down the hatches, you keep going, you deal with the swishing, but you keep on moving forward. And I think that's really I think the best way to invest for a new investor as well as a seasoned investor.
Really good advice there. Words of wisdom from Nomi Prins, bestselling author of Collusion: How Central Banks Rig the World. You also have a brand new book. I know you're working on it, Permanent Distortion. Expected due date next year?
Yes, it's the thing with my publisher. I'm imagining early next spring. But I will definitely let you know as that happens. I'm still finishing it up and sort of actually incorporating a lot of what I just called swish that's happening in the markets with the various asset classes and components, which will be a key sort of ending set of chapters. So.
Well, it's a fitting working title, and we look forward to it. But in the meantime, get Collusion. It's an excellent read. Nomi, you're absolutely fabulous.
Thank you.
Come back anytime to StansberryInvestor.com. Thank you for this wealth of information.
Thank you so much, Daniela. Thank you.
And thank you all for watching. We'll have much more for you, so be sure to stay tuned. In the meantime, remember to share us where you watch us. That's it for me. I'm Daniela Cambone.